Hi, I'm Mark Rosano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Hopefully you had a great Thanksgiving and a long weekend. Unfortunately, I was able to catch some of the things that my kids had this weekend. So I'm currently fighting off something that's there. So just bear with me. I apologize because I'll be a bit nasally, but we can get through the EIA data, I'm sure. So we're going to break it up into the three segments, and we want to look at the shift in refining capacity and what does that mean for flows. Then we're going to look at the trucking data and how that continues to get worse and what does that mean for diesel. And then really discuss the OPEC Plus meeting coming up and what we expect to come out of that, either things that are likely to happen, that could happen, and how is that going to impact OSPs going forward. So when we look at some of the different underlying flows, I thought this was a really good chart that shows, where we have new refining capacity coming online. And one of the things that we've talked about before over the last couple of years, for those that have been following us, is that it's not that we have a shortage of refining capacity, because we don't in the world. We have a shortage of refining capacity in certain areas of the world. And realistically, there was, whether it was conscious, unconscious decision to essentially offset, and because we knew Asia, we knew China was building a lot of capacity, we knew Middle East was building a lot of capacity, and Japan made a decision that they weren't going to upgrade. Australia's been shuttering, Europe and the US have been shuttering capacity, and the idea was essentially, well, there'll be a available product. Now, the problem is you're trusting that China will, one, build quality products and a quality system, but two, and more importantly, that they'll act as a capitalistic society where, if it's cheaper to sell it internally, then they'll sell it abroad, and if it's more expensive to sell it internally, they'll wherever they'll make the most money. But they deal with quotas and export quotas, import quotas. So you're never going to get an efficient market with that kind of hindrance. Now, the Middle East is something different. And for those that have known me as long as some have, I had said that there was no reason that you wouldn't see a shift in the way they were going to manage their system. Because if you have oil, you're going to, in the Middle East, and let's just take Saudi Arabia for an example. So Saudi Arabia has the option of exporting crude or exporting a higher value product, whether that be gasoline, diesel, chemicals. So why export the raw material when you can export the higher quality material? So we had assumed and predicted correctly that you were going to get an increase in refining capacity within the Middle East. So we have several facilities that are currently coming online since October that will help adjust, not in a huge way, but it'll help drive some distillate into the Atlantic Basin as some of this comes on. And at the same time, as a way for Russia to get some of their diesel into Europe, but by way of coming into the Middle East first and then continuing on, whether it's after being commingled or the diesel coming from Russia is consumed within the Middle East, and then they export the difference. And here's to give you an idea of what they rely on. So when you look at Europe, you can see how much Russian diesel really came into the market. So when you look at Saudi Arabia, it hasn't really changed all that much, but you could see Saudi Arabia and UAE numbers get bigger, Russia gets smaller, but it's not because it isn't Russia. It's Russian. It's just because it's coming, essentially circumventing some of the price cap or some of the restrictions, which just increases cost, because now you're putting it on a boat from Russia. The boat now has to go all the way to the Middle East, get offloaded, get put into a tank, then get put back on a tank, and then shipped out into the Atlantic Basin. So you're increasing miles per ton, you're increasing the different costs per barrel. So that's just going to, again, provide some of that inflation, which is why we talk so much about that stagflationary period. And when you have the issues that have continuously happened within Europe in terms of strikes, in terms of some of these unknowns, that's created some of these other pitfalls in terms of just operating normally. Now, there's ways that this could be adjusted, but right now, this is something that we've seen going through November. It'll be interesting to see what happens in December if we can get that price cap. And if that price cap happens, if we see Russian diesel go down further, which would put more pressure just because Europe does not have storage in a similar way the U.S. or the East Coast doesn't have storage. So it's going to create additional pressure points within the European economy. So now when we look at total oil and product stocks, so here you can see it flip from to a surplus. So it went from minus a deficit of 24.7 to a surplus of 3.2. But it's really important to see that flip from surplus to from deficit to surplus. It's at a pinch point. So if you look, nothing really changed for 2022. It's just the comps got easier. So as the comps got easier, it just means that we were able to flip to a surplus, not because we had this massive surge in storage. It's just the comps got a bit simpler on a total oil product level, and now we've flipped to that surplus. So then when you look at total crude stocks, land and floating, flip to surplus from minus 4.8 to positive 14.3. And again, when you look at 2022, there's really not a huge difference between the two outside of the comps got easier. And as the comps got easier, all of a sudden you're showing a bigger surplus. But realistically, there's just a significant amount of crude that is both in transit and in floating storage, which is creating some of the contango that we've talked about, creating some of the other problems that we've seen. And these are pinch points that we want to look at as we go through the remainder of this segment, as well as segment 3. Total oil product stockpiles have continued to rise. Deficit narrowed from 19.9 to 11.1. And a lot of that is on the back of gasoline, though we have started to see some additional distillate coming into the market, which again is putting us closer to what is normal. Well, what we're above where we were in 2021, and you can see we're getting closer to the average from 2017 to 2019. But when we break it down, land storage is still not in this huge spot. Land storage total deficit widened from 42.2 to 42.7. West of Suez, deficit widened from 28.8 to 31.4. East of Suez has continued to rise. The deficit widened slightly from 9.7 to 9.9, but we see east of Suez as a big point of where there's going to be a growing glut, both from Russian crude, but also where is the Middle East and West Africa going to send a lot of their excess, which is currently sitting in the water. And that's something that we're going to talk about more in depth in segment 3. But it's showing up obviously in the floating storage numbers. So the surplus widened from 32.5 to 39. We're now back above where we were in 2021, back above those highs. West of Suez, the surplus narrowed from 4.3 to 2.4. And that was actually driven by the U.S. because the Middle East actually went higher. And that's going to be the bigger issue because when we go into the OPEC meeting, it's like, all right, well, onshore, there's still some storage capacity, but offshore, you're running out. So are you going to cut production and try to clear that glut? So realistically, they could cut production by 250,000 barrels and cut OSPs to be more competitive and try to move that product into the system. East of Suez, surplus widened from 21.5 to 25.2, and we expect to see a lot of that Asia and Middle East flows continue. And then on the west of Suez, we've also seen an increase in West Africa. Even though the U.S. came down, West Africa came back up, Middle East came back up, which again is creating those problems that we've been talking about in terms of where is the crude demand and some of those differentials and how the differentials have weakened. Now, one of the things that we did think was that futures overreacted to the downside. We did see a bit of a bounce, but we're in the end of November, first week of December. Typically in the physical market, you try to push prices up And then once prices go up, you then whittle them down to find a clearing point. And that's going to be something interesting to watch as we progress through December, because we see some more pressure to the downside. Crude stocks, we had a big draw of 12.58 million. Now, for those that have been following us and for those that know the crude markets, it's tax season, and so it's not surprising to see that the biggest drop was in Pad 3. Pad 3 had a drop of 11.02 million. A lot of this is because of the ad valorem tax. You want to clear some of this out. You want to get some of this and reduce your tax bill in general. So we're going to see Pad 3 running light and running at a minimal rate in terms of what's in storage. So that's where we're going to see some of that stress. Pad 2 had another draw of 2.04 million. That's 25.4 million below the 5-year. And then Cushing had another drop of 410,000, which is 20.9 below the 5-year. So that's going to be something interesting to watch, because that it continues to be a problem spot when you're looking at where we are in terms of historics. Against the SPR, we had a draw of 13.98. We're coming to the end of the SPR draws, and it's a good timing side because SPR, we've started to see some demand softness, some of this excess in the water as the SPR is coming to an end. So it's probably a good time to see that come to termination. But again, we're continuing to see some of these draws in Pad 2, which is going to be an important spot to watch. Now, when we turn to Pad 3, you can see that there's typically a drop when you look at different periods. It starts in different at different points. You can see that there's normally that decline, and here you can see that it picked up some pace. 2021, that green line started to roll over. Typically some of the other periods, it didn't happen till the first or second week of December. It all comes down to what do you need, what do refiners require, but otherwise you start to see those moves lower. And again, nothing too crazy from that perspective. Cushing starting to flatline back out. We do expect this to start to move back up as imports continue from Cushing on down. We do have a lot of exports that are continuing, which is going to be the counter to some of those builds. We do see a net build in general, but again, the pace is going to be very slow. It's not going to be this massive surge like actually we saw in 2021. It's going to be something that's going to be very measured, if you will, in terms of some of those increases. When you look at runs went up to 95.2. We were thinking it was going to get to about 95. I'm sorry, we thought it was going to go down, but it all comes down to the run rates, just because we did have Thanksgiving last week. So we were expecting this to come down a bit. Instead, here you can see it actually went up by 1.3%. Still running hot in terms of where things are. And a lot of this is being carried by the distillate crack. So that pulled in another 229,000 barrels a day into refining capacity, with the lion's share being in Pad 3 becoming more operational. So that's something that I think you're going to continue to see happen. We'll likely get to about 97%, but depending on, is it the second week of December, the third week of December? It'll be within that time frame, but we will get that ramp up. Now, when we look at refining capacity here, you can see that we're running at the very high end of what is seasonally normal. But there is that ramp. It's just you can see it started earlier, and now we're going to get to really the highs that we've seen and close to that 97% run rate that we just talked about. Imports had a big drop of about 1.02 million. That's 632,000 below the 5-year average. There was a drop across the board. Pad 2 had a drop, but even with the decline of 214,000, you're still well above the 5-year average. It's going to continue to be elevated coming into Pad 2. Pad 3, a lot of timing delays. So there was a drop of 416,000 barrels a day. We do expect to see a reversal to about 1 million when you look at what happens this week. And then Pad 5 remains lumpy, but you can still see it's well above average, and we should see a little bit of a reverse in Pad 5. Now, Pad 3, just to give you an idea, it's a new seasonally adjusted low, and it's actually the lowest it's been in 2022. So it's all about those timing. We do see that reverse back up, but not in a big way, just back to the bottom of the cloud, but we will get a little bit of that bounce back higher. Pad 2, you can see, as we were saying, as we said last week, we expected it to bounce and then start to normalize, but come much closer to the 5-year average. But with that being said, at the top end of the cloud, we still see a lot of mobility here. There's still a lot of product coming down. Seasonally speaking, imports are going to increase. So again, we're still going to see a lot of those flow throughs, which we're going to continue to see that product coming down from Canada. Implied demand, we didn't get much of an increase in gasoline. It's all about those timing delays. So last week was Thanksgiving. This week, we're going to get a lot of these facilities that are going to rebuild. So essentially, that means that next week, we should see a sizable increase in implied demand. So here you can see it declined by 10,000 barrels a day. So still at about 8.3. Again, we'll get that snapback. It'll probably go to about 8.99. But we still think that the average is still about 8.5 to 8.6 million barrels a day. Distillate declined again, 190,000 barrels a day from 3.8 to 3.6. The issue is trucking. We did get a little bit warmer on the East Coast, which helped offset some heating demand. But again, the other issue is going to remain on the diesel side for trucking. Jet had a pop. Things move a little bit faster when you think about the refill. So a lot of this is reflecting the increase in capacity for the airlines. So we should see that drop back down next week, where gasoline should do the inverse. Gasoline should spike when jet drops. Propylene, small increase, but still continuing to see problems internally. And a lot of that is being driven by the pet chem front and those reductions. Gasoline implied demand, you can see that we normally have that spike. We haven't gotten it yet. We do think we're going to get it at this point this week, and that's something that will get reflected. But when you look at the 4-week rolling average, we're still pretty light for where we should be, which is reflective of, again, just the inability of people to move around, but also the less working work weeks. And now people just aren't going to the office the same way. When you look at the SPR side, you can see that we've had that drop. All of that was driven by Pad 3. So that's something that we're going to have to watch. Are we going to get a drop and then go sideways? Because Pad 3 still needs crude to operate. They still need heavier crude, so you're still going to have to see those imports. But this could have been, let's get it to where we need it to be, and then manage at this level, and then start to increase in January once the tax bills have been accounted for. So again, a lot of these weird moves start to happen in December as they address the different, or it could, and again, it can also start in November, but it's usually end of November, first 2 weeks of December, and then steady state as we get into year end. Days of supply came down. A lot of that is just driven based on the drop in Pad 3 storage, but at the same time, an increase in underlying runs. But then when you look at total U.S. commercial oil storage, things are fairly flat. We did have an increase in diesel and gasoline storage. So even though we had a drop in Pad 3 and in crude in general, we did get an increase in those two areas, which again helped offset some of those drops. So as we've been saying, we expect this level of oil and products to be a flat line across the board. Gasoline storage started to go up. As we were saying, typically there's one drop. It either comes this week or next week, but even if it comes down, we're still on pace to move to the highs, and we do think that gasoline starts to move back up fairly aggressively, just because we're not seeing the demands there. We still have the most available storage when you look at storage issues around the world, because gasoline and light distillate still is oversupplied. That could bring a lot of that product into the U.S. and to take up some of that available storage. Distillate, you can see that we started to move a bit higher. It's important to appreciate the different levels. So even though we're coming back into that bottom piece, there's still those problems that remain on the East Coast. Jet had that drop. Again, that was that movement from point A to point B when you look at the increase in refining activity. When we look at crude futures, we continue to be in contango. A lot of that is just in terms of trying to cover, where even though the futures have started to rise again, especially the front month, you're teetering right on, slight contango, slight backwardation, depending on when you look at the curve. And even though front month has started to go up, you still have a huge amount of cost because shipping rates have been elevated, storage rates have been elevated. So you have to incentivize and cover some of that cost, which has caused some of those shifts. And then when you look at floating storage, we're still at the higher end, especially when you look across 2022, but it's come down a bit. Some of this will, and again, as it's come down, we haven't seen that reflect on the import side. So that's where we talk about some of those timing delays. So this is supporting the fact that we're going to get a bit more imports as we go through this week and even into next week, helping to bring some of the additional crude into pad 3. So that's what we have for you for the overall side on segment 1. Segment 2, we're going to go deeper into the refined product side and where some of that sits.